What you're about to hear might be the most important setup in silver that nobody is talking about. Right now, silver is sitting at a perfect equilibrium. It's up 30% from its recent bottom, and it's down 30% from its recent top. On the surface, that looks balanced. That looks calm. But underneath that calm, something is breaking. And by the time most people notice it, it's going to be far too late to act on it. Before we get into the data, I need to address something important. I have one backup channel. 1. The handle is OGJohnOg_2. There is one video uploaded on it, and the link is always in my descriptions. That's it. If a channel doesn't match that exact handle, it's not me. I bring this up because the situation has gotten dangerous. Recently, a fake channel popped up using my exact thumbnail and my exact logo, and they were out there claiming silver was going to $50, trying to bait people in. Let me be clear about something. Those people are after your clicks and your views. I have skin in this game. I have real knowledge and I have real positions. I'm not here to sell you hype. I'm here to walk you through what the data actually says. So verify the handle and let's get into it. Let's start with where prices are sitting right now. On the western side, spot silver is at $82. Futures are also at $82. Over in Shanghai, spot is at $88 and futures are at $90. That is a $6 premium, and it has been steady since the last video I put out. Now think about what that premium actually means. It means that physical markets in the East are consistently paying more than what the Western paper price says silver is worth. That disconnect between paper pricing and physical reality is not something that resolves quietly. It resolves violently, one way or the other. Now here's where it gets serious. COMEX registered silver has dropped below 100 million ounces for the first time in modern tracking history. We're sitting at 98 million ounces right now, and that happened after a 5 million ounce drain in a single day. Let that sink in for a second. 5 million ounces gone in one day. Meanwhile, open interest on March contracts is sitting at roughly 65,000 contracts. Each contract represents 5,000 ounces, so that's 325 million ounces in paper claims, against 98 million ounces of registered silver. That's a ratio of 3.3 to 1. Paper claims to actual deliverable metal. And first notice day for March is February 27th. That is 2 weeks away. For those of you who trade the short-term charts, let me give you a quick update on the technical picture. In my last video, I pointed out that silver had reclaimed the 150 period exponential moving average on the hourly chart, and I flagged it as potential support. Well, since then, price has dropped back below it. That reclaim failed, and now that same level is acting as resistance instead of support. What that means for short-term traders is simple. While price is below that 150 EMA, the paper side could push things lower. I'm not giving you a buy signal here. I'm not giving you a sell signal either. This is just tape reading. This is education for people who want to understand how price moves in the short term. I'm also working on bringing you more advanced tools in future videos. Volume profile, order flow, sentiment data. But the number one priority, always, is capital preservation. Don't follow anyone blindly. Not me, not anyone. Respect your risk first, and everything else becomes manageable. Now let's zoom out and talk about the bigger picture, because the equilibrium setup right now is textbook. Silver rallied from roughly $63.90 all the way up to about $93. That's a 30% move to the upside. Then it corrected back down to around 82, which is a 30% pullback from that high. So both the bulls and the bears have been validated in their short-term views. Price is coiled right now, caught between paper resistance pushing it down and the physical value narrative pulling it up. This is what a calm before a decisive break looks like. The question isn't whether silver moves. The question is which direction it breaks and when. Let's talk about what the Silver Institute is telling us, because their latest outlook paints a very clear picture. This is now the 6th consecutive year of a structural deficit in the silver market. 67 million ounces short. That's not a one-off. That's not a blip. 6 straight years of the market consuming more silver than it produces. Investment demand is up 20%, hitting 227 million ounces, which is a 3-year high. India alone is importing roughly 220 million ounces. To put that in perspective, that's about 25% of total global mine supply being absorbed by a single country. On the industrial side, demand sits at approximately 650 million ounces, which is actually down about 2%, largely because of fluctuations in solar panel manufacturing. Mine production ticked up 1% to 820 million ounces, and recycling rose 7% to over 200 million ounces, which is the first time we've seen that level since 2012. But even with those increases in supply, the deficit persists. The cumulative drain on above-ground inventories continues year after year. Don't take my word for any of this. Go pull the Silver Institute reports yourself and verify the numbers. Now let's layer in the geopolitical picture, because this is where things get really interesting. China's holdings of U.S. treasuries, stocks, and bonds have dropped to $1.56 trillion. That is a 14-year low. And if you strip out the estimated custodial holdings routed through Belgium, which many analysts believe are Chinese-controlled, the real number is closer to 1.16 trillion. That takes you back to 2008 levels. On top of that, China is actively urging its banks to sell U.S. treasuries. Think about where that capital goes when it leaves the U.S. debt market. It flows into commodities. It flows into infrastructure. It flows into physical assets. Things you can touch, things you can hold, things that don't depend on another country's promise to pay you back. The World Uncertainty Index has now surpassed the highs we saw during both 2020 and 2008. We are in uncharted territory when it comes to global instability, and I want to share a quote here from Jesse Livermore, one of the greatest traders who ever lived. He said, "The big money is not in the individual fluctuations, but in the big swings. You don't make generational wealth trading the daily chop. You make it by positioning yourself correctly for the major moves. And when you combine a multi-year structural deficit with a global repositioning away from the dollar and into hard assets, that is the definition of a big swing setup." But here's something I need you to pay very close attention to, because timing matters, and there is a risk window opening right now. The Shanghai Metals Exchange closes for Chinese New Year from February 15th through February 23rd. That's 8 days where the Eastern physical market goes completely dark. No buyers. No price discovery from Shanghai. And historically, every single time that happens, the Western paper markets take advantage of it. Without Eastern physical demand holding the floor, the paper side has room to push price wherever it wants. We've seen this pattern play out before. But here's what's different this time. Going into this holiday closure, we are seeing record backwardation. That means the front month contract is trading at a premium over the next month out. That is a textbook signal of shortage. It's happening because both investment demand and solar industrial demand are pulling so hard on available supply that the market is paying a premium to get metal now rather than later. And the shorts, the people who are betting against silver on paper, they're having to pay deferral costs to avoid actually delivering physical metal. That's a very uncomfortable position to be in when you don't have the metal to deliver. Let me walk you through what's happening on the macro side, because the broader economy is telling a story that most people aren't connecting to precious metals, but they should be. The jobs gap has gone more negative, meaning unemployment is trending higher. Last week alone, there were 9 large U.S. bankruptcies. 9. That's the highest weekly number since COVID. Consumer defaults have hit 4.8%, which is an 8-year high. The economy is deteriorating in real time. And yet, in the face of all of that, silver is up 150% over the past year. Gold is up 76%. How do you reconcile a weakening economy with rising precious metals prices? The answer is currency debasement combined with supply constraints. The metals aren't going up because everything is great. They're going up because the currency they're priced in is losing value, and the physical supply to meet demand simply isn't there. Ray Dalio has talked about this extensively when he describes how debt cycles end. They don't end in some dramatic collapse where everything goes to zero overnight. They end through devaluation. The debt gets inflated away. The currency loses purchasing power gradually, and hard assets repriced to reflect the new reality. That's the process we are living through right now. Now here's a development that could be a game changer, and most people haven't heard about it yet. Texas is moving to produce its own gold and silver coins that will be eligible for use in IRAs and 401ks. The initial rollout will be commemorative coins, but the plan is to scale up from there. Scottsdale Mint is involved in the production. Think about what this means. This would be the first state in the country issuing its own form of money specifically designed for retirement accounts. If Texas pulls this off successfully, watch what happens next. Florida has been making noise about similar ideas. Wyoming and Montana have too. If even a handful of states follow Texas's lead, you are looking at a permanent institutional bid for physical silver and gold. That's not speculative buying that comes and goes. That's retirement account rotation. That's systematic, ongoing demand that gets baked into the market structure. Let me touch on something that's developing in the rare earths and critical materials space, because it connects directly to the silver story. Morgan Stanley recently put out research showing that demand for rare earth magnets has increased 477 times over the past 25 years, and China controls 90% of production. Futures contracts for critical materials are now being developed, which signals that institutional money is starting to focus on supply chain vulnerabilities in a serious way. What that sets up is the same paper versus physical dynamic that we've been watching in precious metals for years. When institutions start trading paper claims on physical materials that are in short supply, the same tensions emerge, the same disconnects build, and eventually the same kinds of squeezes happen. Let's get back to the COMEX and SLV specifics, because the numbers here matter. That 5 million ounce drain I mentioned earlier broke down as follows. 2.5 million ounces came out of JP Morgan's vault. 1 million came from Loomis, the rest from other registered holders. That brought total registered down to 98 million ounces, below the 100 million threshold for the first time. March open interest at 65,000 contracts represents 325 million ounces of paper claims against that 98 million ounces of registered metal. And here's a detail that should make you sit up straight. February deliveries have exceeded 100% of February's open interest. More metal was delivered than the open interest suggested would stand for delivery. That's unusual, and it tells you that demand for physical metal is running hot. On the SLV side, something interesting happened. The net selling that occurred on January 30th completely wiped out all of the buying that had accumulated during January. That looks like a coordinated stop hunt. Push the price down, trigger the sell stops, shake out the weak hands. But here's the thing. Despite those crashes, physical metal flowed back into the trust. The silver returned, which puts the banks in an awkward position. Whether price goes up or down, they're facing buyback pressure on physical metal. And as we approach March 27th, that pressure only intensifies. Now, I always want to give you the other side, because if you only hear the bullish case, you're not getting the full picture. Here's the bearish argument. Those March contracts don't have to stand for delivery. They can roll forward to May. They can cash settle. The market has mechanisms to avoid a physical crunch, and those mechanisms have worked before. The Shanghai closure creates a manipulation window where paper can push price lower without Eastern physical demand providing a floor. The 150 EMA on the hourly chart is broken, which means technically the short-term trend is vulnerable. The broader economy could stagflate, which creates a messy environment for all assets. And paper markets have successfully contained physical tightness before. They've done it multiple times, so it's not impossible that they do it again. That's the bear case, and it's legitimate. You have to respect it. But here's what the bears have to answer for. February deliveries running above 100% of open interest. March paper claims at 3.3 times registered silver. India absorbing 25% of global mine supply. A sixth consecutive structural deficit. Record backwardation in Shanghai heading into the closure. A persistent $6 premium between East and West. Every single one of those data points has to be dismissed or explained away for the bearish thesis to hold. So what should you actually be watching over the next few weeks? First, pay attention to what happens during the Chinese New Year closure from February 15th through the 23rd. Watch how the Western paper market behaves when Shanghai goes dark. Second, track delivery intentions as we approach First Notice Day on February 27th. How many March contracts actually stand for delivery versus rolling or settling in cash? Third, watch that 150 EMA on the hourly chart. If price reclaims it and holds, the short-term technical picture shifts. If it stays below, the paper side has room to work. Fourth, when Shanghai reopens on February 24th, watch that premium. Does it hold? Does it widen? Does it narrow? That will tell you everything about whether the physical market is getting tighter or looser. And fifth, track the March contract closely. How many roll to May? How many stand for delivery? How many cash settle? The ratio between those outcomes will signal whether the physical squeeze is accelerating or being managed. The technical picture calls for caution. I'm not going to sugarcoat that. But the fundamentals, the geopolitics, and the timing are all building pressure in the same direction. Something has to give. Verify every piece of data I've shared with you independently. Pull up the Silver Institute reports, check the COMEX warehouse data, look at the Shanghai exchange numbers. Don't trust me, trust the data. And let me be crystal clear about something as we wrap up. Nothing I've said today is a trade signal. This is not financial advice. This is not me telling you to buy or sell anything. This is a warning to pay attention, to verify the data, or to stay blind. That's your choice, your capital, your decisions, your responsibility. Invest with logic, not with hype. And I'll see you in the next one.